Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder here from Seeking Alpha for another episode of ETF Spotlight. Today we are diving into the world of emerging markets, and not only that, but the internet side of things across emerging markets, which obviously people are looking for the growth aspect, right? We have the internet, we have technology in America and of all the other developed countries. But today, where is the opportunity in emerging markets? And that is why I'm excited. We are joined by Kevin T. Carter. He is founder and chief investment officer over at EMQQ Global. We're going to dive into his fund today. EMQQ. Go ahead and look it up here on Seeking Alpha, add it to your watch list. And now, Kevin, let's get into the conversation. I love to start where we all start every episode is, where did this fund come from? Where did you see the need? How did you develop the strategy? Can you give us a little background look?
Sure. Well, I got involved with emerging markets about 20 years ago and had some clients that asked me they wanted to invest in China. And I said, well, I don't know anything about that, but we'll take a look. And we assumed we'd use a China ETF. There was only one China ETF that day 20 years ago, the iShares FXI, the original China ETF. And I asked our portfolio managers for a list of the companies in the index. And what I saw immediately was that almost the entire portfolio were government-owned banks and oil companies. And that these are not really companies that are trying to grow their profits. And so I realized the indexes were broken. I decided that investors should really just focus on the consumer sector. As you said, there's an implicit in the word emerging is some kind of growth. And the thing that's emerging are 6.5 billion new consumers. So originally I was focused on the emerging market consumer. But then the smartphone showed up and I realized the best consumer companies were now called technology companies, and I launched EMQQ to capture that growth.
Now, you mentioned back when you started, right, China, since we're going to focus on that because we're got a couple questions here about that. Why not just use, investing in the funds? Like, you're picking individual names within the Chinese markets. A couple of them are in your top 10 holdings. I mean, the pretty significant weighting there. Why not use something nowadays like a K-Web and become more of a fund-to-fund kind of style?
Well, actually, long before K-Web was launched, I launched CQQQ with Guggenheim to capture the China part of the story. Again, that's where I got started, and I saw that the internet companies were really the best way to invest. And the reason is that, there's basically three things sweeping the planet, three mega trends that we don't think of as trends because we've been involved in them for generations now. But the first one is consumption. Everybody else wants food and better clothing and heaters and air conditioners and vacations and college educations. And they're also getting their very first computer today. And it's not a desktop, it's a smartphone. It's not an Apple smartphone either. It's an Android-based smartphone. And those 6.5 billion consumers are also getting the internet at the same time. We've had the internet since, at least for me, since 1995. So 6.5 billion new consumers, pocket-sized supercomputers, high-speed internet. And because in most of these areas, no one's had a bank account before, they don't have a car, there's no Target stores, they're leapfrogging. And so, we own China. The K-Web portfolio looks like a lot like our China portfolio, but now the rest of the world's joining us because basically the first wave of the internet was the United States and the developed world. The second wave of the internet was China, and now we're on the third wave, which are the other emerging markets. And within that, you have Brazil, you have India, you have Africa, Southeast Asia. So this is really, the next 20 years, there's going to be a huge amount of growth in the emerging markets internet sector, especially beyond China.
Yeah, unfortunately, they won't get to experience all the dial-up modems back in the day. But obviously, they get the best side of things since we've developed it so much from here. So diving deeper into, the strategy, but let's look behind the curtain. How do you determine which stocks actually get picked from which countries and how is this constructed?
Well, for starters, every emerging and frontier market is eligible in our portfolio. And again, we're looking for the tech leaders, the consumer tech leaders, the Uber of India and the Facebook of China, the same things that have dominated our market, but now the same thing in the emerging markets. And so first is, you need to generate your revenue from emerging market, internet, and e-commerce related activities. Now, we don't care what country your headquarters are in, and we don't care what stock exchange your stock is on, because a lot of these companies, they don't actually trade in their home market, and they may not even be headquartered. Mercado Libre, for example, is probably the best known company. I'm sure a lot of your viewers and listeners know Mercado Libre. It's the Amazon.com of Brazil. So it dominates all e-commerce in Latin America, and Brazil being the largest part, but also Mexico and 20 other countries. The headquarters are in Uruguay. So the database may not see the company for what it really is. So we don't care where your mailbox is. We care about where your customers are. And I think a lot of your investors would be shocked to know that Mercado Libre is not included in the traditional index. If you own an iShares or Vanguard emerging market strategy, you don't own Mercado Libre, the best performing company in Latin America, the largest company in Latin America, and the best performing stock. Instead, your Latin America position in an iShares or Vanguard fund, the biggest position is Petrobras, the corrupt oil company. And the second biggest position is the preferred shares of Petrobras, and you don't get Mercado Libre. So as long as you're an internet company, we don't care what stock exchange you're on. Again, Mercado Libre trades on the NASDAQ. So we don't care where you're located or trading, we care about the revenue. And as long as you are, in fact, an e-commerce internet company in the developed world, if you meet our minimums for market cap and liquidity, we'll include the companies.
Now, you're talking about directly what you just said about where the consumers are, where the revenue is being generated. Now, you're looking at emerging markets, but also frontier markets. How do you know when to, look specifically? I mean, frontier markets are considered risky, right? They're small, they're super early on. How do you determine, okay, well, that consumer base, it looks like they're really supporting the revenue of this company, so therefore it should get, whatever increased weighting within the fund?
Sure. Well, what you find is that, again, a lot of these business models cross borders, pretty easily. So Mercado Libre, again, headquartered in Uruguay, but historically it was headquartered in Buenos Aires, which is Argentina, which was a frontier market, but was then demoted to a standalone market. I don't think of it as an additional risk. It's just more geographic exposure. It doesn't mean that these companies are headquartered in frontier markets, although there are a couple. It just means they may have a lot of the revenue coming from countries like Bolivia or Paraguay, or countries that aren't considered emerging markets, potentially just because they don't have a stock market. Because you have to have a stock market to actually be classified as an emerging or frontier market.
All right. Now I want to circle back to China, right? As we mentioned earlier in the episode. Now you have the ability to go to a 45% weighting, I believe, for the country as your cap for this fund. Let me just ask and open the floor. Obviously, we see everything going on with the administration and China, and it hasn't started just now, right? We can go back to Trump, 1.0 trade war, or even before, right? How do you think about the risks of that country and the United States and how it might be affecting revenues of these companies going forward?
Sure. Well, it goes back even further than that. I mean, the first day that I got involved with emerging markets 20 years ago, China was already, I think, feared in some ways, but mainly, I think, misunderstood. But the reality is the Chinese internet companies have had massive, massive growth in the last 10 years. And while China might be an emerging market in a traditional sense, when it comes to the internet, when it comes to e-commerce, China is by far the most developed country in the world. And it's not even close. People might be surprised to know that of the entire world's e-commerce, China is more than half. And China's e-commerce is 4 times that of all the other emerging markets. So China is a very big and important country. And we had a couple years of significant selling in China. There were a number of government things that went on that were regulatory things, all of which I agreed with and supported. But the problem is that most investors have never been to China. All they see are these terrible headlines. They assume they're all true. and they just really weren't. And I think finally this year, the investment world shined a flashlight back on Chinese internet companies and realized that they're legitimate, they're big, they're profitable, they're sitting on a lot of cash, they've been buying back stock, and they have AI that's right up with ours. And so I think China's back. It got to a point where people like Jim Cramer called it uninvestable. And if you think about the way the markets work and sentiment, bullish and bearish, I'm going to get rich, I'm going to lose all my money, you can't get more bearish than uninvestable, right? And so I think that even after the positive performance this year for the Chinese internet companies are still very cheap. And the other thing, getting back to the geopolitical picture, just this morning we have more favorable news that our representatives and the Chinese trade representatives just wrapped up a meeting, and the president's going to talk with Xi on Friday. But I think something important's happened this year, which is that we started talking really tough with China on these tariffs, and they basically said, forget it, we don't even want to talk to you. And we realized we need them, and we need them at the very tip of the spear. We need the magnets that they control to do almost all of our manufacturing. And when we started, threatening them and the magnets stopped flowing, we perhaps have realized that we don't hold all the cards anymore. China may, in fact, have a pretty good position to negotiate, and I expect that position will continue to be stronger and stronger going forward.
Now, you mentioned, the numbers about how big that specific country is around internet and commerce. Is that more of just because they have 1 billion people and there's such a large weighting and they're all transacting, or is that more innovation fueled, as you're talking about, with the technology side of things and business practices?
I think it's a combination of things. I think that, and this is happening in all of the developing world, but there's this leapfrogging going on. When we got smartphones, we had computers before that, right? We've had plenty of grocery stores and department stores and traditional commerce. China was already the most advanced emerging market when the smartphone showed up, and their population quickly embraced it, and they leapfrogged a lot of our. We've had a gradual experience with consumption and technology. China's large young population, again, it's gotten older now, but 15 years ago it was still pretty young, and they were the first ones to really scale it up. And they also, they're pretty advanced in a lot of other ways, certainly versus the next very large pool of population, which is India, which is basically 20 years behind China. So, but going forward, India is going to become a digital beast in its own way, and that's already happening. I don't think people really appreciate how good the India story looks right now and how early it is in terms of the internet and e-commerce there.
All right, now let's go back to the fund for a second. I want to make sure investors are aware of your fund compared to something like the MSCI Emerging Markets Index or the S&P 500. When people are thinking about emerging market, let's just say the MSCI. How is your fund different, and what should investors know about comparing it to a index like that?
Well, again, the biggest problem in emerging markets is the index. I mean, the investing's really simple. I like to consider myself an Omaha kind of investor, a Berkshire sort of person, and investing is really simple. The reason companies have value is because they make profits for the owners. And the only way to grow the value is to grow the profits. And if you look at the MSCI index, in the last 10 years, it hasn't grown its revenue. It hasn't grown its profits. And the biggest problem is the state-owned enterprises don't care about that. And they represent a quarter of the index. And so we don't own the state-owned enterprises. I mean, that's, from the very beginning of my emerging market life 20 years ago, I recognized that as the biggest problem. So you're not going to find those. And what you're going to find are the internet leaders like Mercado Libre in Latin America, which isn't in the Vanguard or iShares product. If you look at Southeast Asia's internet leader, C Limited with the ticker SC on the New York Stock Exchange, it's not in the index either. So you're not going to see a lot of overlap. Now, the Chinese internet companies were finally added to the index, but it was only 3 years after the Alibaba IPO that they woke up and realized they had this big hole. So you're going to see in our portfolio entrepreneurs backed by US venture firms, a lot of them trading on our exchanges, which, that all adds up to better corporate governance. And you're going to see a lot of growth. In fact, it's not just the fastest growing part of emerging markets. It might be the fastest growing sector in the world, certainly over the last 10 years and going forward as well.
Kevin, before we wrap up here, I just want to ask you one more question. So you're deep in this space, right? And you have been for quite a long time. So where do we go from here? Is there Web 3.0? Is it an evolve of internet, new technology of quantum computing leading to VR, AR? Like, where do we go from here with how this consumption in this space is going to grow?
Sure. Well, in the case of China, it's going to be a lot of AI. And I think, again, the market's already finally starting to wake up and realize that Alibaba in particular, but a lot of the other Chinese tech leaders, Baidu with its self-driving car business, which is about the size of Waymo's, that these companies are legit. They will compete in AI, physical AI. They'll deploy it within China. But for the rest of the emerging markets, it's still all about people getting their first smartphone. I mean, you still have about 3 billion people that don't have any computer. But the price of a smartphone is, you can get a brand new smartphone in India now for $12. So in most of the emerging markets, this is going to be the basics: getting online for the first time, connecting with friends, having food delivered, hailing a ride. It might not be an automobile, it might be a motorcycle or a rickshaw or something, but it's going to be a lot of those consumer basics for most of the emerging markets. And India will deploy AI. And in fact, India is very quickly becoming pretty important. It's the largest number of ChatGPT users are now in India. But India is focused not on how big the model is. They're focused on what can we actually do to improve people's lives using this AI and associated technologies. And because they've built this great digital public infrastructure, they really have a huge advantage in deploying AI at the scale of the population.
All right, Kevin, let's go ahead and leave it there. Everyone, Kevin T. Carter, founder and CIO at EMQQ Global. Go look at this ETF on Seeking Alpha. I know emerging markets can feel risky, but sometimes there's a fund like this that might make sense for your portfolio. So feel free, go check it out, put it on your watch list, maybe add it to your portfolio. That's up to you. But everyone, we'll see you again here next week for another episode of ETF Spotlight. And Kevin, again, thank you so much. Appreciate it.